Hoping to retire this year? 5 money moves to make before you retire. Planning for retirement, it should take place over decades, maybe years.
Yes.
It should. We're all looking forward to it.
That's right.
But it does take some planning.
It does.
So we have 5 questions that we need to walk through before you retire.
That's right.
And the first one, maybe one of the most important financial decisions you'll make: when to claim Social Security.
Yeah, so Social Security will pay you over $1 million in your lifetime, and we want to maximize that payment. So you've got to determine whether you trigger it early or at full retirement age, or you defer until 70, which is your max amount. It's very individualized. So I encourage anybody who calls, we would run a Social Security analysis for them. And in that analysis, we can give you 3 or 4 varying options. It will also have an optimal strategy in there. So it depends. It depends on age difference of spouses could be a contributing factor to when to trigger Social Security. Do both spouses have an equal level of Social Security? And then it's a matter of looking at your investable assets and how much income you can generate from those to dictate whether you need Social Security to not damage your portfolio and draw it down, or whether you can defer and get those automatic increases over time and use investable assets, or some folks have idle cash that you can use to get to a full retirement age.
Right. So let's walk people through, because we have a visual that we want to show them about the detriments of kind of claiming early, how that means a lifetime of reduced benefits.
Yeah. So if you trigger between 62 and 67 or before 67, your full retirement amount, you also have to be conscious of the fact that you may be in a penalty box. If you make too much income, if you're not fully retired, they can start taking away dollars of your Social Security and you're collecting it. Keep in mind that Social Security is also taxable, so that needs to be built into your plan as well. But at age 67, no more penalties, but you're still exposed to taxes, and then obviously you can defer all the way up to 70, and that's your max amount. You've got to turn it on at 70, otherwise you're giving the government your money.
Don't do that.
Yeah.
All right, next, determine whether you have adequate savings. But how do we know?
Right, and that's kind of a misnomer, I believe, in the financial services industry. A lot of large box firms or investment firms will talk about the magic number.
Right.
Do you need $1 million to retire? 1.5. I recently saw a report that said you need $1.9 million. That's, to a large extent, that's the wrong number to look at. You've got to look at how much your financial life can pay you in retirement. It needs to generate your paycheck. So all of your financial resources, Social Security, pensions, dividends, fixed income, that becomes your income stream in retirement.
Yeah.
So that's the important number. It's not that the total value of your assets isn't important, but if you could replace your paycheck with monthly income from all of your financial assets, you basically are getting paid like you're going to work, but you don't have to go to work. That sounds like a pretty good deal to me. So that's what we shoot for at Hoffman Financial Group.
I would take that deal.
Yep.
All right, next, decide on a withdrawal strategy. We've heard of the 4% rule. I know you're not a big fan.
Not at all.
I've heard you tap your buckets in a certain order.
Yep.
Usually it's tax deferred, then taxable, then tax-free. We can show people that order. What do we need to keep in mind when we're thinking this through?
Yeah, so let's talk about the cardinal sin, which is telling your financial advisor, send me 5% of my assets annually, or send me $5,000 a month or $10,000 a month. That may cause your financial advisor to sell out of positions in your portfolio at the wrong time. Nobody would want to sell stocks when they're down unless they're not good stocks. You would want to shave off gains when the market is going up. More so than picking a percentage or telling your financial advisor, send me an exact amount, an equal amount monthly, put that onus on your financial advisor and basically tell them, design an income plan and tell me how much you can generate an income for me without invading my principal. Because you want to use your principal for the fun stuff, you want to use the growth of your principal for fun stuff, and or you want to leave it as a legacy. So when we look at the withdrawal strategy, you should have 3 buckets of money. You should have tax deferred. I think everybody's familiar with that. The 401ks that were created in the 80s, we pay into them. We do not pay taxes on those contributions until we take the money out, and it's taxable back to $1. Unfortunately, it's taxable as income, which is the worst tax. Why do I say that? Because it's unpredictable. We don't know where taxes are going to be in 5 or 10 or 20 years. So you should balance that bucket with taxable money. It's called non-qualified. It's non-qualified through the IRS to qualify as a retirement bucket. But you pay just on the growth when you achieve it. You can have unrealized gains in a taxable account that you don't pay taxes on annually. You only pay on it when you sell it. You can generate dividends for income from it. It's also a valuable bucket to have if you're going to leave money to your children, because they will get a stepped up cost basis on their stock portfolio or your stock portfolio that they inherit. So it can be very powerful from a tax standpoint. The best bucket of all is the Roth bucket. Yep. That's the tax-free bucket that we have no restrictions, no requirements to draw down. When we use that money, we don't have to pay any taxes on it. And we can leave that to multiple generations, kids, grandkids, etc. And they're not required to take that money out, but it's a tax-free benefit for them. Typically, the way I look at this strategy is if you can have a third, that's optimal. Very rare to see that. Most people have all or a large majority of their money in tax deferred. We can work with them on how to transition it to taxable and Roth accounts.
And the next would be to schedule check-ins. Make sure that you're on track. But how often do you think people are doing this? Well,
at Hoffman Financial Group, we make it mandatory that every one of our clients gets a quarterly text, and they're able to book their appointment online. They can book it as a Zoom meeting, or they can come to one of our 7 offices. But it's important to meet with your financial advisor, we believe, 4 times a year, even if it's just a check-in for 15 or 20 minutes, for us to give you the scorecard on how we've done for the quarter, talk about what we're seeing for the remainder of the year, and just basically find out what's going on in your life and what your potential needs are. They may have changed over the last 3 months. So we want to stay in close contact with our clients.
And last, quickly, even though it's very important, consult an advisor.
Yeah, you need an advisor. You need that second set of eyes, second set of ears. And if you're married, now you've got a team of 3. So very powerful. Definitely interview several financial advisors before you choose one, but choosing one nearing retirement is important.
Yeah, you only get one chance to do it right. Chris, thank you so much.